Let's try to learn more about Supermicro. Could we have identified the issue before the accounting firm fired this company? Anytime a public company has a major change, they need to release an 8K, and they file that through the SEC. And a company has 4 business days to file an 8K, and it's for major matters. Not small things like if a secretary quit, but major things like a bankruptcy, an acquisition, when they change CPA firms. So we can look at their 8Ks, and you could do this for any company. And sometimes you could identify things before the market knows about it, and then you could buy the stock or short it, depending on the news. This 8K was posted on 9/30. On 9/27, they entered into an amendment to their loan and security agreement. This amendment extends the date the company is required to deliver full year 2024 financial statements. So they extended it from 9/28 to 11/27 because under this loan agreement, they're required to provide their financials. They were required to provide the financials by 9/28, and that's not going to happen because they changed accounting firms. So if they don't provide it by 9/28, they could be in default, and then the lender could force them into bankruptcy. They were able to amend this agreement, so now it's due 11/27. Because it looks like if they didn't get this extended, they would have had to pay $250 million. Let's take a look at the next 8K. They published this on 9/26. So this was published a little over a month ago. This talks about their 10-for-1 stock split. The price at one point was over $1,000. So to make it more affordable, they did a split. But it doesn't change the value of the company. Let's look at the next 8K on 9/20. On 9/17, the company received a letter from the NASDAQ indicating the company is not in compliance with NASDAQ listing rules because they didn't file their 10K on time. The 10K was due 8/29, and the letter stated that they have 60 days to get back into compliance. So they have to submit their financials within 2 months. So 2 months from 8/29 is 10/29. They did not meet that timeline either because, as you know, Ernst & Young quit. Let's see this 9/3 filing. It's a letter from the CEO to the shareholders, and the letter is dated 9/3. Supermicro will be delayed in filing its annual report for fiscal year ended June 30th. We don't foresee any material changes in the fourth quarter and fiscal year 2024. This is good news. I continue to have strong confidence in our finance and internal teams. Well, that definitely didn't happen. There was a huge material change. And that's what we're trying to uncover right now. He also references Hindenburg, the company that wrote a short report on them. And Hindenburg said this company made false and inaccurate statements. The CEO says we will address these statements in due course. As you know, short seller reports are designed to drive the stock price downwards, to serve the short seller's interest to the detriment of the company's shareholders. Let's look at some more recent 8Ks. They posted one on 10/30 and another on 11/1. So let's look at the one on 10/30. On 10/24, their accountant Ernst & Young resigned. We discussed with Ernst & Young the reason they resigned. We don't expect any restatements of prior quarterly reports. Ernst & Young was hired to complete their annual financials, the financials that end June 30th. That was the only reason they were hired, and they were hired in March 2023, so over a year ago. Ernst & Young never submitted a report for this company. They resigned while conducting an audit of this company's fiscal year end. So they didn't want to be associated with this company at all. They didn't want to sign their name on anything. In July 2024, EY communicated to the audit committee concerns about several matters relating to governance, transparency, and completeness of communications to EY and other matters pertaining to the company's internal control over financial reporting. So this company, Supermicro, also hired Cooley LLP and forensic firm Secretariat Advisors to perform an investigation on this company's financials. So in addition to Ernst & Young, they hired 2 other accounting firms. And nobody completed anything. These companies are still reviewing this mess. After receiving additional information through the review process, EY informed the special committee that the additional information EY received raised questions, including whether the company demonstrates a commitment to integrity and ethical values consistent with Principle 1 of the COSO framework. They also mentioned Principle 2 of the COSO framework, whether EY could rely on representations from certain members of management and from the audit committee. Principle 2 is when the board of directors shows they're independent from management. Because the whole point of a board of directors is to make sure management is doing things properly. That doesn't appear to be happening at this company. For example, the board and management cannot be the same exact people. Maybe there could be some overlap, but they need to be independent. COSO stands for the Committee of Sponsoring Organizations of the Treadway Commission. It was actually created in the 1970s and 1980s to fight fraud scandals. The purpose is to provide companies guidance for implementing controls to prevent, detect, and manage fraud risk. It gained a lot of popularity with Enron, Tyco, and WorldCom. Because companies subject to SOX, Sarbanes-Oxley, adopted COSO in order to satisfy all the SOX requirements. Without going into too much detail, the 5 foundations are control environment, risk assessment, control activities, information and communication, and monitoring activities. Ernst & Young said, "We are resigning due to information that has recently come to our attention, which has led us to no longer be able to rely on management's and the audit committee representations, and they are unwilling to be associated with the financial statements prepared by management. And after concluding we can no longer provide the audit services in accordance with applicable law and professional obligations." Although SMCI recognizes EY's decision as final, it disagrees with their decision to resign. Nevertheless, we have taken their concerns seriously and will carefully consider the findings of the special committee and any remedial or other actions needed. Here's the letter Ernst & Young provided to SMCI. The letter's dated 10/29. They actually sent this letter to the SEC, not to SMCI. This letter is just them agreeing to this 8K report. They did issue another 8K on 11/1. Here's another amendment to that loan agreement, the one we mentioned at the beginning of the video. They amended the date from 10/28 to 12/31. So now they have until 12/31 to complete their annual financials. Let's see if we get more information from news reports. Supermicro is set to release Q1 results on 11/5. Wall Street analysts anticipate 73 cents per share, a 115% year-over-year increase. Revenue to rise 205% to $6.5 billion. However, despite these positive expectations for Q1, the stock is down 60%. The decline was due to several factors, including concerns about the company's reputation and financial restatements. On 10/30, their auditor, Ernst & Young, stepped down, stating they could not rely on financials provided by management and the audit committee, and they did not want to be associated with the firm. In August, short seller Hindenburg accused the company of accounting manipulation and other questionable practices. The NASDAQ issued a notice to this company for failing to report their 10K on time. Although bullish analysts argue that this company is well positioned to benefit from rising AI infrastructure investment, supported by its robust product line. Let's look at this report issued by Hindenburg. They issued it on 8/27. Supermicro, fresh evidence of accounting manipulation, sibling self-dealing, and sanctions evasion at this AI high flyer. Before we look at the Hindenburg report, I just want to note that the company was delisted at one point. In 2018, they were delisted from the NASDAQ because they delayed financial reporting for nearly 2 years. Same exact thing that's happening now. They settled that delisting with the SEC in August 2020 over violations in accounting practices between 2014 and 2017. So this is not their first rodeo. They've been doing this for a long time, and they paid $17.5 million in penalties. In the Hindenburg report, they said Supermicro is still engaging in accounting violations. They rehired executives who were involved in the earlier scandal. They're also evading US export restrictions by shipping advanced technology to Russia. 2 of this company's suppliers, Abelcom and CompuWare, are controlled by the brothers of Supermicro's CEO. Now let's look at the Hindenburg report. Supermicro, a $35 billion server maker based in Silicon Valley, has ridden the AI enthusiasm. Our 3-month investigation, which included interviews with former senior employees and industry experts, as well as a review of litigation records and customs records, found glaring accounting red flags. evidence of undisclosed transactions, sanctions, and export control failures, as well as customer issues. In 2018, Supermicro was temporarily delisted from the NASDAQ for failing to file financial statements. In August 2020, the company was charged by the SEC for widespread accounting violations, mainly related to $200+ million in improperly recognized revenue and understated expenses, resulting in elevated sales, earnings, and profit margins. Less than 3 months after paying a $17.5 million SEC fine, this company began rehiring top executives that were directly involved in the scandal. A former salesperson said almost all of them are back. Almost all the people that were let go are now back. Supermicro waited only 3 months after the SEC settlement before restarting improper revenue recognition, recognizing incomplete sales, and circumvention of internal accounting controls. The salespeople are doing channel stuffing or shipping defective products, per interviews with former employees and customers. One salesperson described pushing products to distributors based on made-up demand forecasts, completing a partial shipment, then later coming up with an excuse why the rest didn't happen. Former employees said the culture has not improved. 3 senior employees who left in early 2018 were rehired. The former CFO, who was involved in accounting violations, was hired by a company owned by the CEO's brother. The new CFO, praised by coworkers for his integrity, was hired in 2018 to help the company get out of the scandal. He also helped the company get relisted, but he resigned in January 2021, and he was pushed out by the other executives. 2 of their suppliers, Abelcom and CompuWare, are controlled by the CEO's brothers. Those 2 companies have been paid $1 billion in the last 3 years. Abelcom is also partly owned by the CEO's wife. The relationships seem oddly circular. In 3 years, their market cap has gone up 1,600% from $2.2 billion to $35 billion. It'll be zero before you know it. The company is wasting so much money, their margins are going down. Their gross margin was always above 15%. In the latest quarter, it's 11%. There's a lot of evidence of channel stuffing. Channel stuffing is when you ship more goods to your customers than they need. So this quarter, your revenue looks high, artificially high, but when your customers return those products, it's going to make those quarters look artificially low. Channel stuffing is a deceptive practice. It inflates sales and earnings by sending more products than a customer needs. It's usually done right before quarter end or month end or year end to try to up the sales for that time period. The company inflated revenue by $200 million by shipping more products than the customer asked for. The SEC said the company engaged in channel stuffing, claiming executives pushed employees to maximize end-of-quarter revenue. They even explain it right here. Channel stuffing inflates sales through over-shipping and over-invoicing. A former sales director said products will be shipped to a dark warehouse just to hold the products so they get the sales up, and then those products will get returned the following quarter. So you receive sales in the current quarter, the items would get returned the following quarter. When there's a major accounting scandal, the company fires the employees involved, and of course will not hire them back. That's just crazy. But that's what they did. They hired most of them back. Here are Supermicro's sales to the 2 companies that are owned by the brother of the CEO. In 2021, Abelcom $120 million, CompuWare $113 million. 2022 and 2023. The US has bans on exporting to Russia, and Supermicro said they have not recorded revenue from Russia since the day before the war started. But their exports to Russia have spiked more than 3x since the Ukraine invasion. Hindenburg really did their homework. They have copies of sales reports. You see people's LinkedIn profiles. This blue line is Supermicro's exports. The red line is third-party exports to Russia. And Supermicro controls these third parties. That's just a way for Supermicro to circumvent the process. The exports are not under their name, but it's under the name of a company they control. That's like if you can't buy a certain stock, but you have your wife or your friend buy it for you. This is a really long report. I could spend days on this. Some stuff is not as relevant as others. But let me know if you liked the video and I can make another one on this report. If you want to learn how to master financial statements, click on the video in the top right corner. Thanks for watching.